Hi guys, back with another video. On this video, we'll be covering a very essential topic. Everything I've been saying so far hasn't made sense to you. This has to make sense because without this, everything else doesn't make sense, basically. So we'll be discussing today about risk management and the mindset to have, the proper mindset to have as a trader, yeah? So first of all, I'll be covering what account equity is, flipping of an account is, and the real trader mindset. So let's begin. Risk management is the foundation of every successful trader's career. It's not about avoiding losses, it's about controlling them. Trading is a game of probabilities, and no matter how accurate a strategy is, losses are inevitable. The key is ensuring that no single loss or series of losses can wipe out your account or confidence. True mastery in trading comes not from finding perfect entries, but from surviving long enough to consistently profit. At its core, risk management means protecting your capital. Professional traders understand that capital preservation is priority number one, because without capital, there is no opportunity. The general rule is simple. Never risk more than 1 or 2% of your account on a single trade. This allows for emotional control, consistency, and long-term sustainability. Even when multiple consecutive losses might occur, your account remains healthy, allowing you to keep trading objectively. So I'll be covering position sizing, I'll be covering account flips and equity, and other terminologies you might need to know. So stay with me. So guys, position sizing. Position sizing is where mathematics meets discipline. It ensures that each trade carries a predefined level of risk, regardless of the setup. The formula is pretty much straightforward. Like your position size is equals to the account balance multiplied by the percentage risk divided by the stop loss in pips. This means that your trade size adjusts depending on your stop loss distance. I'll cover it more later in the video. Larger stops require smaller positions, while tighter stops allow for slightly bigger ones. Proper sizing keeps emotions out of the equation because every trade has a controlled and predictable outcome. Stop losses and take profits are essential components of risk management. A stop loss defines where your trade idea becomes invalid. It's your safety net against unexpected volatility or whatever might happen in the market. It should always be based on structure, not emotion. On the other hand, a take profit level ensures that you lock in gains and maximize a consistent risk to reward ratio, typically 1 to 2 or even better. This means you can lose more trades than you win and still be profitable, as your winners outweigh your losers in value. Beyond numbers, risk management is deeply psychological. Many traders fail because they trade based on hope, fear, or greed. Over-leveraging, revenge trading, and inconsistency stem from emotional decisions rather than logical planning. Discipline, on the other hand, not excitement, is what separates professionals from amateurs. When you accept that losing is a natural part of trading, you switch or you shift from trying to win every trade to executing your plan with precision. Ultimately, risk management is what keeps traders in the game. It is the silent force behind every profitable career and the reason consistency beats luck over time. Remember, trading isn't about winning every battle, it's about surviving every storm. The market rewards those who respect it. Plan for the worst and let probabilities play out in your favor. In trading, your first job is to protect your capital. Profit is secondary. Manage risk, stay disciplined, and always play the game to win. Equity. This is another important part I want you guys to understand or grasp the concept. Equity and how it protects you in your trading. Equity represents the total value of your trading account. This includes your deposits and unrealized gains or losses. Protecting equity is the foundation of long-term success, as losses directly reduce a trader's ability to participate in future opportunities. Key ways to protect your equity. Number 1, risk per trade. You would want to limit your risk to 1 to 3% of your total equity per trade to prevent catastrophic losses. The next one is stop loss placement. Placing your stops outside obvious liquidity zones, trend lines, or inducement areas to avoid being prematurely stopped out is definitely an essential way of risk management. Position sizing and leverage. Adjust trade size according to the stop distance and maintain moderate leverage to control loss exposure. I'll cover all of this later in the video. during our chat work session. Protecting profits. Use trailing stops or partial exits to secure gains and prevent reversals from eroding your equity. Then avoid emotional trading. This is extremely important because I'll also cover psychology in further videos. Fear, greed, and revenge trades can destroy equity. Discipline and adherence to a trading plan are essential. Integrating smart money concepts like buy-side liquidity, POI inducements, POIs, and false breakouts can help traders make more informed entries and exits. Also, reducing risk and improving risk to reward ratios. Remember, in trading, survival comes first, profit comes second. Protecting equity ensures consistent participation, giving traders the chance to capitalize on market opportunities while minimizing losses. The next part we're about to talk about is flipping accounts and how dangerous it is, because it's like a pandemic now. I see online every day people are posting about how they flip $10 or $100 to $10,000. Not saying it's not possible, but these are not sustainable and they are bad risk management practices. So I expect everyone to shy away from these practices because they become addictive, and when you are successful at it once, you want to do it over and over again, and it is bad practice for anyone that is trying to take trading as a career long term. Account flipping, that is rapidly growing a small account into a large one through aggressive risk taking, has become a popular fantasy amongst traders. While the idea of turning $100 into 10,000 sounds exciting, and it is possible, to be honest, but it often hides the real danger, unsustainable risk exposure, and eventual equity destruction. To flip an account, traders usually risk large percentages of their equity, sometimes as much as 100%, 50%, 80%, or even more. This approach may produce fast results in rare cases, but statistically, it guarantees eventual failure. Markets are unpredictable, and one losing trade can wipe out weeks of progress, or even the entire account. The problem isn't flipping itself, it's the lack of risk discipline and the emotional addiction to high-risk wins. Flipping encourages greed, overtrading, revenge trading, and even a poor psychology. It disconnects traders from structured risks management, making them treat capital like disposable money instead of business equity. This mindset destroys consistency and prevents long-term growth. Professional traders protect their capital first and grow it steadily through low-risk compounding. They treat risk, that is what they stand to lose on every trade, as a leverage to compound on. They understand that consistency and not quick profits leads to wealth. A 2% risk model compounded over time is far more sustainable than gambling with oversized positions. In short, flipping accounts may bring temporary excitement. Yeah, it's good to hit a home run once in a while, but long-term pain. Fast growth is meaningless if it's not repeatable. The goal isn't to double accounts, it's to build a skill, discipline, and equity that lasts a long time. We are here for the long game and not just to flip accounts and hope we can make a home run, right? I want to take you to the charts now and show you some of these examples and concepts that I've touched on so far so that you can catch along and get accustomed. See you on the other side, guys. So hi guys, welcome back to chat work. So I'm going to be running you guys through how to properly calculate risk management when on your charts. For example, somebody like me, I usually go for 1 to 2 or 1 to 3. Between that, I find the balance between the 1 to 2, depending on the setup that is presented to me by the markets, right? So I'm giving a case study of GBP USD, right? Because I traded this yesterday, I traded this today as well, and they were both successful. So let me use yesterday for example. So I want to teach you guys how to properly calculate your risk, calculate your risk, right? So first of all, this is what you call the long and the short position. If you look on the chart, this is the short position and this is the long position. This is how the short position looks. And this is how the long position looks. So these tools are to kind of shorten the brain work that it takes to calculate the number of pips. So this does it for you automatically. So if you just put it It shows you how many pips you stand to gain and how many pips you stand to lose. This is the ultimate risk management tool. Always take it seriously, guys. It's very important. And when it comes to risk management, there are two approaches to go about it, right? If you bring out your long position tool now, you can just go about it two ways. Either calculate a fixed lot that you'll be using across your trading account or however you want to go about it, or a fixed percentage risk on your account. These are the two ways to go about it that I know and I have tested over the years, right? So let me take this my trade for example. So on this trade, it was a success, and I was risking 12.2 pips to make 35.5 pips for a total risk to reward of 2.91 RR. So you see, within my risk parameters. So if I was risking a standard lot on this trade, I stood a chance to lose $122 to make $355. So that is how risk to reward works. If this trade was to go against me and take me out, I would have lost $122. But it did not. It went straight to take profit and I profited off the trade. Right? So yeah, that's in the first one. Then on the next segment, I want to teach you guys how to calculate, based on percentages, how to calculate your risk, basically, or what you can risk on an account. Be it 2%, be it 3%, you know what you stand to lose on every single trade that you take. So come with me, guys, as I show you proof. So guys, quick recap. So I was saying you can either choose fixed lot or fixed percentage risk. I explained in the previous slide that for a fixed lot, assuming that I'm risking a standard lot per trade, then this would be me exposing $122 to the market, right? Then for my TP, 35.5 pips, that's me exposing 355 pips to the market. $355, sorry, to the market. That's that for fixed lot. Then in terms of fixed percentage risk, it's a little bit different. So here's the little calculation that we have to do to, get it. So let's assume that your account balance is 10,000. That's your equity. Your starting equity is $10,000, right? And your SL, this SL is 12.2 pips SL, and your risk is a consistent 2% per trade. So the quick formula you need to get is account balance times percentage risk divided by stop loss in pips, right? Very quick and easy. It's nothing too crazy, right? So the equity is 10,000 times 2%, which is 2 over 100, represented as 0.02, divided by 12.2, right? Being standard is 10. You understand that? So this is 200 divided by 122. That's equals to 1.64 lots per trade. So for this risk, which is 12.2, and you're risking 2% per trade on a $10,000 account, you are risking 1.64 lots per trade. Okay, so putting this into dollar amounts now, this is you are risking on this particular trade, you are risking 1.64 lots per trade. That is basically $16.4 per pip. I know this is a bit tricky, but that is basically how to calculate percentage profit. Right? So in dollar amounts, what you'll be exposing with this risk, 1.64 lots, will be $200. You stand to lose $200 on this trade, and you stand to gain $582, right? risking 2%. That is what percentage risk gives you. Yes, you can make more, but you might lose a little bit more as well, because risking 2% of your whole account on one single trade is a significant sum of your account. Okay, so that is it basically, guys. That is basically risk management. I know it is more than this, but you get the muscle memory whilst you keep practicing, whilst you keep like being a trader. You understand how to manage your risk. Even there are some practices that you can have a $10,000 account, but trade it like a $2,000 account just to preserve equity, just in case of a drawdown. And on the flip side, you can also have a $2,000 account, but treat it like a $10,000 account. Although that is more risky and risk averse, but if you trust your strategy and you know how you trade, you know what you expose per trade, and you know your goals for that particular account, then you can as well do that. So I can really not explain these are like the basic pillars of risk management. I really can't explain every aspect or every way that traders actually manage their risk, but these are just like the basic beginner terminologies that I can put together for a layman getting into trading to understand, right? So that being said, I think I've covered most of everything you need to know about risk management. Guys, it is extremely important to practice risk management. Flipping $100 to $10,000, it might happen once, twice, but you might lose that $100 30, 50, 100 times before you actually hit that home run. So strive for consistent profitability. That is where the magic happens. This is a business. It is not gambling. So I need you guys to actually lock in and understand the craft of it, because it takes time. It took me time. I didn't get here by just, gambling. I did not get here, and I'm still not there yet. I'm still on my journey. I still have real plans of what I want to use trading to achieve for myself, But so far, so good. It's going well. We're making some money here and there, and life is good. So if you actually got any value from this start work, or I've been getting value from my previous videos, make sure to leave a like on this video. Make sure to subscribe on this video. It will help me a lot. So also, if you have any questions, make sure to reach me. However, DMs on Instagram, DMs. I've been getting some of your DMs as well. I really appreciate that. But I think that is all on this episode of risk management. I have to do an episode for this because a lot of people have been telling me, how do I manage my risk? How do I do this? This is how you basically do it in a nutshell. Of course, this is not everything. I can't wrap it all into a 10-minute video, but you guys need to practice. That is how you understand these things better. There's no textbook. The market is ever changing. There's no textbook that can actually show you exactly how things will be every day. You have to be in the market to experience things for yourself, to get that muscle memory in. So yeah, that being said, guys, see you on the other side. Risk management, as you can see, is very essential, guys. This is what separates traders who survive from those that disappear. It's not about how much money you can make. It's about how much you can keep. Every trade carries inherent uncertainty, and your only real control is how much you're willing to lose before walking away. Understanding position sizing, setting proper stop losses, maintaining a consistent risk to reward ratio, and protecting your equity are what keep you in the game long enough to win. This is the part most traders ignore until it's too late. But real trading is about longevity, not luck. You're not trying to win every trade. That's reality. You're not going to win every trade. You're trying to stay profitable over hundreds of them. The market rewards patience, discipline, and consistency, not greed or impulses. Once you master risk management and you stop trading emotionally, start thinking like a professional. So, as you continue your journey, remember, preserve your capital, respect your plan, and trade smart. If this episode helped you to see the importance of managing your risks like a pro, make sure to subscribe, like, and drop me a comment on how you manage your trade. And as always, keep practicing, keep staying disciplined, and remember to play the game to win. See you in the next one, guys. Peace and love.